Hey everyone, it's me from a financial firm. And today we have breaking news. Canada has just announced they are implementing an all-out trade war against the United States of America, targeting over $60 billion worth of goods and services, effectively putting the entire American economy on notice that there will be significant repercussions for any negative actions taken against Canada. This is not something that we had expected to happen so soon, especially given that Canada is known for being a very friendly country. But unfortunately, this conflict has been building up for quite some time, and it has now come to a boiling point. In today's video, we're going to cover what exactly has gone down and how this will impact both Canadian and American markets. So let's get right into the charts and the data. Here's what's happening. As you know, recently, the US government decided to increase interest rates by 25 basis points, which was the exact same move that the Bank of Canada did as well. Both countries simultaneously raised rates, yet the USD rallied higher against the CAD. Now, even though this might seem like a small move in currency exchange rate terms, this caused a pretty big problem north of the border. You see, when the US dollar rallies higher relative to the Canadian dollar, this causes Canadian imports to become more expensive. And given that Canada is a net importer of goods, this puts upward pressure on inflation. Now, even though this isn't ideal for Canada, they've managed to deal with this situation in the past, and it wasn't a major concern until recently. The issue is that throughout 2023, the Federal Reserve has been signaling that they plan to maintain these high interest rates for quite some time, with many Fed members projecting rates to hit 5.4% by May of next year. Well, at the same time, the Bank of Canada is starting to signal that they will begin cutting interest rates within the first half of next year, which means that there could be a pretty big divergence in monetary policy between these two countries. And if that happens, it would likely cause the US dollar to continue strengthening against the Canadian dollar, which would make it much more difficult for the Bank of Canada to control inflation. Now, this is where things start to get interesting because in response to the recent rate hike from the Federal Reserve, Justin Trudeau has announced that he wants to implement tariffs on over $60 billion worth of American goods and services. Not only that, but he also stated that they plan to match every single rate hike that the Federal Reserve implements over the next year, which would put the entire American economy on notice that there will be significant repercussions for any negative actions taken against Canada. As you can see, the Prime Minister of Canada stated that if the Fed raises interest rates again, then Canada will raise interest rates as well. And this will likely continue throughout the duration of this cycle unless, of course, the Fed makes a U-turn and begins cutting rates once again. In addition to this, Trudeau also stated that Canada plans to retaliate against any additional rate hikes from the Federal Reserve by increasing tariffs on certain goods. At this time, they have targeted $60 billion worth of American goods that could face a 10% tariff, including whiskey, chemicals, plastics, apples, nuts, and many other products. Now, in terms of which companies will be impacted by this, according to Bloomberg, the biggest losers would be Archer Daniels, which provides agricultural products. They would see a 98% increase in tariffs, followed by Westlake Chemical Partners, which would see a 93% increase, along with many others. So, as you can see, this is a pretty broad range of goods that could potentially be impacted by these new tariffs. And this could lead to increased costs for businesses and consumers alike. For example, if the Fed were to raise interest rates one more time before the end of the year, then all of these products would immediately face a 10% tariff. And if they were to raise interest rates twice more in 2024, then this tariff would rise to 20%. So as you can see, this is becoming quite costly for American businesses who rely on these Canadian goods and services. Now, the thing is, this trade war is just getting started. And there are three important details that you need to know about what has gone down that nobody seems to be talking about. First, here's what the governor of the Bank of Canada had to say about this. He stated, "We will do whatever is necessary to bring inflation back down to 2%. Now, the thing is, this statement implies that the central bank won't hesitate to take further action if needed to control inflation. And this includes raising interest rates beyond what they signaled in their previous projections. For example, in their most recent report, they indicated that they projected 3 rate cuts in 2024. However, if inflation remains high, then they could opt to raise rates further. And this would put even more pressure on the US dollar, which would negatively affect the Canadian dollar. So with that said, what exactly is the Central Bank of Canada planning to do? Well, that brings us into the second point, which is that Canada has been buying millions of dollars worth of foreign currency in order to weaken their own dollar. In fact, they have been doing this for quite some time now. And according to this article from Bloomberg, the central bank purchased 7 billion Canadian dollars worth of foreign currency last quarter alone. And here's the thing. This is having a pretty big impact. Since April of this year, the loonie has declined by over 10% against the US dollar. Not only that, but we can actually see this on their balance sheet. As you can see, the Bank of Canada has been adding more foreign currency assets while simultaneously reducing their holdings of Government of Canada bonds. What this means is that they are selling off government bonds in order to buy foreign currencies like the euro and the US dollar. And this weakens the Canadian dollar, making it less expensive for Canada to import goods and services from other countries. However, this is starting to change. As I mentioned earlier, since April, the loonie has declined in value against the US dollar. And in September, the Central Bank of Canada stopped buying foreign currency. Instead, they began selling foreign currency, which could mean that they are beginning to scale back on their efforts to weaken the Canadian dollar. This could be in response to the recent escalation in tensions with the United States, or it could simply be a sign that they believe the loonie is already weak enough. Now, it does look like they've begun to scale back on these purchases because they think that the loonie is weak enough. But there is another reason why this could be taking place that nobody seems to be talking about. That leads us into the third point. You see, the federal funds rate is currently sitting at 5.5%, which is the highest level that we have seen since the year 2005. In fact, this is such a high level that money market funds are offering close to 6% yields, which is essentially risk-free investing. Not only that, but the yield curve is now completely inverted, with 30-year treasuries offering lower yields than 6-month treasuries. This is such a crazy situation that it has caught the attention of Jerome Powell himself. And he warned investors that if this continues, then it could be a sign that something is wrong. Well, if this is what a normal yield curve looks like, and this is what the current yield curve looks like, then this begs the question, what if Canada is taking advantage of this situation? You see, they are paying around 5.5% to borrow US dollars, and they are receiving around 6% in interest from holding onto American treasuries. This means that they are locking in risk-free profits by simply borrowing in US dollars and investing in the US Treasury market. And if that's the case, then this would explain why they've been scaling back on their foreign currency purchases, because they are starting to see better returns by simply holding on to American dollars. So as you can see, Canada is now facing some pretty serious decisions that could have a major impact on their economy. On one hand, they need to keep their currency competitive in order to maintain a healthy trade balance. On the other hand, they don't want to drive up the cost of borrowing, which could negatively impact economic growth. Ultimately, it will be interesting to see how this situation plays out and what actions the Canadian government takes in response to the recent developments. I appreciate you guys for watching. If you enjoyed this video, please make sure to leave a like comment below to support the channel. And as always, I will see you back here tomorrow